Would you like to add some certainty to your portfolio? Want to know about a stock with a business model that's almost guaranteed? Like the idea of collecting market-beating dividend income that's safe and growing? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. Also, make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is engaged in providing necessary sovereign defense products and services. Think back to thousands of years ago. Societies had bows and arrows to defend themselves with. Thousands of years later, here we are with the nuclear-powered aircraft carriers this business manufactures. Sovereign defense was necessary way back when, it's necessary now, and it'll be necessary well into the future. That kind of certainty could do your portfolio some good, as could the growing dividends this business is handing out. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Huntington Ingalls Industries Inc., which appear to be trading at a significant discount today. Huntington Ingalls Industries Inc., stock ticker HII, is a major American defense company operating as the largest independent military shipbuilder. Founded in 1886, Huntington Ingalls is now a $7.5 billion by market cap military powerhouse that employs almost 15,000 people. Huntington Ingalls primarily designs, constructs, maintains, and repairs a range of nuclear and non-nuclear ships. These ships include aircraft carriers, submarines, and amphibious assault ships. The United States Navy is their largest customer, generating almost 90% of the company's revenue. The company operates across three segments: Newport News, 60% of fiscal year 2020 revenue, Ingalls, 29%, and Technical Solutions, 14%. In a world that's constantly uncertain, demand for sovereign defense is certain. It's been certain since societies were using bows and arrows thousands of years ago. It'll be certain thousands of years from now. It's simply an unfortunate truth. In fact, defense companies offer a counter-cyclical effect in this sense. The more uncertain the world gets, the more demand there is for sovereign defense. Against that backdrop, you have an oligopoly with entrenched players that basically vacuum up all of the large contracts within their respective spaces. For example, Huntington Ingalls has no competition when it comes to building nuclear-powered aircraft carriers for the United States. If the US military orders an aircraft carrier, Huntington Ingalls is the company that will build it. Indeed, the technology and scale required to build modern-day defense products further entrenches established players. It's very difficult for new competition to suddenly enter the picture. Favorable industry dynamics layered on top of a basic level of certainty promotes fertile ground for growing profit and dividends. The company has already increased its dividend for 9 consecutive years. That might seem short at first glance, but that's only because the company was spun off from former parent company Northrop Grumman Corporation in 2011. So Huntington Ingalls has been paying and increasing that dividend for as long as it possibly could do so. The 5-year dividend growth rate is 20.1%. Outstanding. This growth comes on top of the stock's yield of 2.4%. That yield is quite a bit higher than what the broader market offers. It's also 90 basis points higher than the stock's own 5-year average yield. And with a payout ratio of only 26.6%, this is one of the more secure dividends you'll find. I love dividend growth stocks in what I refer to as the sweet spot. A yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. This stock is squarely in that spot. Looking at business growth, Huntington Ingalls grew its revenue from $6.575 billion in fiscal year 2011 to $9.361 billion in fiscal year 2020. That's a compound annual growth rate of 4%. Solid growth here. I like to see mid-single digit top-line growth from a mature business like this, and they delivered. Meanwhile, earnings per share moved from $2.91 in fiscal year 2012 to $17.14 in fiscal year 2020, a compound annual growth rate of 24.81%. Notably, I moved the starting year for earnings per share growth rate 1 year forward. This is because the company registered a GAAP loss for fiscal year 2011. A combination of buybacks and aggressive margin expansion definitely helped spur this excess bottom line growth. The outstanding share count is down by about 15% over the last decade, while net margin has more than doubled. Looking forward, CFRA believes that Huntington Ingalls will grow its earnings per share at a compound annual rate of 9% over the next 3 years. This would be a fairly significant drop from the kind of growth the company has proven out over the last 10 years. While 9% growth is nothing to sneeze at, I think this might be underestimating the true potential of the business. Keep in mind, Huntington Ingalls just reported fourth quarter and full year fiscal year 2020 results on February 11th. A highlight was the $6.15 in fourth quarter earnings per share, beating consensus by $1.62. Talk about underestimating this business. Also, their backlog is $46 billion as of year-end 2020. That's more than 6 times as much as the company's entire market cap. Even if they only come in at 9% near-term earnings per share growth, we're looking at a setup where dividend growth can easily exceed that mark by virtue of the low payout ratio. I would say that high single-digit dividend growth should be a base near-term expectation. It wouldn't be surprising at all to see something higher than that. Moving over to the balance sheet, the company has a solid financial position. The long-term debt-to-equity ratio is 0.89, while the interest coverage ratio is over 8. Profitability is robust. As foreshadowed a little bit earlier, the expansion in net margin in recent years has been nothing short of spectacular. Over the last 5 years, the firm has averaged annual net margin of 7.39% and annual return on equity of 35.85%. For perspective, net margin for fiscal year 2012 and fiscal year 2013 came in at under 4%. This is a high-quality business from every angle, and with massive barriers to entry, scale, technological know-how, R&D, IP, long-term contracts, high switching costs, and a unique government relationship, there are durable competitive advantages in place. Of course, there are risks to consider. Litigation, competition, and regulation are omnipresent risks in every industry. While competition is limited, regulation is amplified by way of direct regulatory oversight. The very business model comes with geopolitical risk here. The current democratic regime in the US government could aim to limit defense spending, which would impact this business. There's heavy reliance on only one customer. There's also execution risk, especially with the large backlog. The company must continue to complete projects in a timely and cost-effective manner in order to avoid backlash, scrutiny, and possibly reduced order flow. Overall, I see these risks as very manageable. That's especially true if the stock is bought at an attractive valuation. With the stock still 20% off of its 52-week high, I'd argue the stock is attractively valued right now. The stock trades hands for a price-to-earnings ratio of 11. That's less than half of that of the broader market's earnings multiple. It's also well off of the stock's own 5-year average price-to-earnings ratio of 16.1. If we move past earnings, we can see that the price-to-cash flow ratio of 7 is much lower than its own 3-year average of 11.2. And the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is at the top end of what I usually allow for, but I think this business deserves it. There is no element of the company's growth profile that is below this mark. Both the long-term earnings per share growth rate and long-term dividend growth rate are well in excess of this. And with such a low payout ratio, the dividend is primed to grow at a high rate for years to come. The dividend discount model analysis gives me a fair value of $246.24. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates HII as a 4-star stock with a fair value estimate of $191. CFRA rates HII as a 4-star buy with a 12-month target price of $215. I came out somewhat high Averaging the three numbers out gives us a final valuation of $217.41, which would indicate the stock is possibly 16% undervalued. Here's the bottom line, guys. Huntington Ingalls Industries Inc. is a high-quality defense contractor with durable competitive advantages and a massive backlog. This business model offers certainty in an uncertain world. With a market-beating dividend, almost 10 straight years of dividend increases, double-digit dividend growth, a very low payout ratio, and the potential that shares are 16% undervalued, dividend growth investors would be wise to consider defending their portfolios with this stock. And now for a special news announcement, I want to alert you about another defense company, Lockheed Martin Corporation, stock ticker LMT. On February 22nd, the company was awarded 2 U.S. Air Force contracts worth almost $1 billion combined. All Lockheed Martin seems to do is land huge contracts and add to their backlog. This is just another reason why it's one of my top 5 stocks for 2021. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alert. I'll see you next time.